One of my strategy is closing the gap. Okay, I don't really call. I mean, sometimes it's known as averaging down, but averaging down it applies more so for a long-term strategy, long hold. Who are doing for like over a year or so. That's fine. You can do averaging down, but in swing trade, what I tend to do, and I don't know what it's called in swing trade. I mean, like I said, I've not read any books or whatnot. I'm intuitive in what I do, and especially in swing trade anyway. So this is a classic example of a stock where I have what I'm losing £600, right? Actually, I'm losing a lot more than that because I have the same stock in my other one, on another account, and I'm in the same situation. The reason why I've not acted in that time, because as per my strategy, I have to prove that the support is here, right there. This has been the case for 1 month. Let's have a look. Can you see? Up and down, up and down, up and down, up and down. Great, that's great. Dropped here below all-time support, the last support, previous support, which was for a good month or so, right? I was waiting to see if that will drop or not, which it did here. Now, this is why I didn't go in, because if I had gone in here to average down, I could have come out, but to close this gap from here to there, you need to invest. I would have had to invest. I would have needed to have invested maybe £8,000-9,000, and then I could come out with a profit. But it's not guaranteed that it will hold. It could go further down. Then I'm screwed basically. Then trying to close that gap, like if I was to go here. So if I was to go here, for example, right, and it went down, to close that gap, it would have costed me even greater amount of money. And more money you put in, the more loss, the more chances of you losing a greater amount. Why is that? Because more money you put in, the loss on 1% or even 0.1% is far greater than as it is basically, right? So you might think, okay, 34% loss. It is a big percentages loss. But if I was to put £10,000 in here and I lost, say, 5%, that would be overall, it would be amount to more money, as in like pound wise, I would lose more pound probably. Okay. And so this is why it's not always correct to look at just the percentages wise. You also need to look at other factors to decide what you want to do with it. But in my case of strategy, I need to see that confirmation that that's going to hold. Now, yesterday, it reported its earning. It was a mess, basically, right? As it was a mess, if you noticed that its support is still on the line, it did not break through the support. Also, it has resistance here around that figure. So taking that information, taking that it's on a downward slope, which is a great risk, as in of losing money. The high probability of you losing money is greater because of the downward sloping motion, the trend. The stock is volatile, which is a positive thing actually, but also it uses support a lot. However, having said all of this, its drop needs to be measured. So if NEO does not drop, it's already all year low. If it does not drop, it's max. Or I mean, we are talking about it could drop to anything really. Previous lows of going back many years ago. So let's have a look at it quickly. That's March 2000. Then we have one high here. That's again January 2020. It could drop further. So what all these indicate is that when I act on this, I need to be cautious. I need to see what's going to happen today. If the sell-off doesn't happen today or this week, which it should because of the fact that it's poor reporting, that would be an indication to me that it's actually holding. That support is actually holding here. Market momentum on this is positive in terms of the support, and that would be an indicator that the stock is stable here. Of course, there's always a risk. It could go further down. However, it's a risk you take, and I may take a risk right here and go in with a couple of £1,000 to close that gap to nearest 3% or 4% or 5%. If I can close the gap by 5%, I come up with a profit of probably about 6% profit, which is great amount of profit. So this is the strategy. and I've shown this strategy in my other videos, but I've not done a particular video for this particular strategy as per se. But this is the strategy where I'll use different technical datas, probabilities, and then you have to close the gap fast. You have to really throw all your money at it quickly, in order, because it's a volatile stock and you see it's moving quite fast. It's volatile stock, and in doing that, it has happened. I have managed to successfully come out of profit, on profit, while break even on my plug, profit on other stocks, doing the exact same thing. So it's a strategy that works for me. It's not the same as averaging down. I call it closing the gap, as fast as you can, basically, once you know there's support, because it could further drop. By closing the gap as fast as you can on a high volatile stock like this, like for example, can you see lots of spikes up and down, up and down? It's very likelihood that you can come out with a break even or a small loss, or worst case scenario, it could plummet. But hopefully, this is stock trading. It's not risk free. So this is a calculated and educated guess, educated estimation that you have to make, and live by that, basically. If it flops, it flops.